Okay, in this video, we're going to talk about depreciation expenses on capital equipment. And capital equipment, basically, we're talking about long-term assets, assets that can be used in more than one accounting period. And I'm going to use this simple example of Don and Mike here to demonstrate why we would use depreciation to allocate the cost of those assets over the period they're used. Now, that goes to that matching principle in accounting that we so strongly emphasize. All right, let's look at Don. Don gets into the lawn care business. He rents a commercial grade lawnmower for $500 per year cash, and then he commences to cutting grass. He uses it for 4 years, decides he doesn't like lawn care anymore, and moves on, who returns the lawnmower to the lawnmower rental shop and is done. Each year, he earned $2,200 for mowing lawns with that lawnmower. Now, he did other stuff, of course, but just from the mowing lawn part, $2,200 of revenue. The rental expense was $500, which gave him a gross profit for mowing lawns of $1,700 per year. Okay, so over the grand total of the 4 years he was doing all this, Don earned $8,800 in revenue, had $2,000 in rental expense, and that gives him a gross profit. Gross profit simply the mower rental minus the rental expense, the cost of sales, cost of providing sales, is $6,800. Compare that to Mike, and Mike decided to get into the lawn care business. Instead of renting one, he bought one. He paid $2,500 cash and started cutting grass. He also cut grass for 4 years, making $2,200 in revenue each of those years. At the end of 4 years, he decides to give up lawn care business and sells the lawnmower on eBay for $500. Well, let's look at his cash flow here. Now, this is the improper accounting treatment. Year one, he's $2,200 of mower revenue, and then when he bought the mower, that's a $2,500 expense, so his gross profit's negative $500 or negative $300 rather. But then he doesn't have any mower expense in year two or year three, and it's actually a negative expense. It's cash coming in year four. So in year four, he gets $2,700 gross profit, $2,200 in revenue, minus a minus 500. All right, this is a minus because he's selling it and getting the money back. So it's a negative expense. And then his gross profit is $2,700. Over the 4 years Mike's in business, $8,800 of revenue, $2,000 of lawnmower expense, and gross profit of $6,800. Those look exactly alike, don't they? If you look at it over the entire period. All right, so the reason that we don't expense or claim all the expense on buying long-term assets in the first year is exactly this. What it does is it distorts the annual profits. That's because we try and match the revenues and the expenses to the period they're actually using. So what did Mike actually do over this period? Mike actually spent about $2,000 on the cost of the lawnmower. From an accounting standpoint, what we want to do is depreciate the lawnmower. And depreciation is just accounting ease or accounting word for allocating the cost over the period that it's being used. Okay, so to do that, what an accountant would do or a business would do is start with the cost or the price, all right, the purchase price of the equipment minus any salvage value. And here the purchase price is $2,500, the salvage value is $500. All right, so if you took that amount, that would be the total cost over the period. that you're going to use it. In this case, you're going to use it for 4 years. Then the average then would be 2,500 minus the $500 of expected salvage value divided by 4. This is what we call straight line depreciation. And so a business would simply allocate $500 expense to each of the years that it expected to use the equipment. All right. Notice that when you use depreciation, it works like it allocates it the same as if you were renting it from somebody. Okay. Now the cash flows were different, and how that would show up in a cash flow statement. All right. So in the cash flow statement, these would be cash flows from investing activities. That'd be negative 2,500 as the cost, and a positive 500. All right, you use the wrong word, and not as the cost, but as the cash flow. On a cash flow statement, we would show negative 2,500 as a cash outflow in investing activities from buying the asset in year 1, and we'd show $500 cash recovery, a positive cash flow from investing activities in year 4. All right, that's cash flow. The difference between cash flow and accounting. All right, remember that we started that out early on. Cash flow is dollar bills in and out of the business. The accounting is allocating the economic value over the life of the business. All right, so there's your simple example of why we would use depreciation to more closely align the cost of the lawnmower to, misspelled my own name, the cost. So that's how we would use depreciation expenses to allocate the cost of the lawnmower to the revenues generated by the lawnmower. All right, so depreciation of long-term assets or capital assets.